Most people think 10,000 rupees a month is too small to matter. They look at that number and immediately compare it to big salaries, big investments, and big success stories. And because it looks small, they dismiss it. They assume wealth needs something dramatic, a lucky break, perfect timing, or a very high income. But real wealth does not usually begin with something dramatic. It begins with something boring, something repetitive, something most people underestimate. In my last video, I explained how a 5,000 rupee SIP can grow into 1 crore over a long period of time. That video showed the power of patience and compounding over decades. Today, let's slow things down. Let's remove the long-term fantasy and let's talk about something far more realistic. What actually happens if you invest 10,000 rupees every single month and you do it consistently, for just 10 years. No skipping, no stopping, no guessing, just a simple disciplined habit. 10,000 rupees a month may not feel impressive, but 10,000 rupees a month is 1,20,000 rupees a year. And over 10 years, that adds up to 12 lakh rupees invested. Not profits, not returns, just your own money. 12 lakh rupees, that number alone surprises many people. Because consistency quietly accumulates more than most people expect. Now let's talk about returns. To keep this realistic, we'll assume a 12% annual return. Not an aggressive number, not a best-case scenario, just a long-term historical average for diversified equity investments. With this assumption, after 10 years, your 12 lakh rupees grows to roughly 23 lakh rupees. Almost double. Not overnight, not dramatically, but steadily. And this is where many people feel disappointed. They expected something bigger. They expected faster growth. They expected excitement. And this disappointment is exactly where most people misunderstand compounding. In the early years, compounding feels invisible. You invest month after month, and the numbers don't move much. The portfolio grows slowly. Sometimes it even goes down. This is when people start questioning the process. They ask themselves if they chose the wrong fund, if they started too late, if they should stop and try something else. This is the most dangerous phase of investing. Because compounding does not reward impatience, it rewards time. Compounding does not grow in a straight line, it grows unevenly. In the first few years, growth feels flat, almost boring. But in the later years, the curve starts bending upward. In fact, in the last 3 years of a 10-year investment journey, your money grows faster than it did in the first 7 years combined. This surprises almost everyone, because our brains expect linear progress. But money does not compound linearly. It compounds exponentially, slow at first, then faster, then suddenly. This is why time matters more than timing. Now let's talk about the single mistake that quietly destroys this entire plan. Stopping. Most investors do not fail because they choose bad investments. They fail because they stop. They stop during market crashes. They stop during uncertainty. They stop when headlines are negative. They tell themselves they'll restart when things are clear, but markets are never clear. And market crashes are not dangerous for long-term investors. They are discounts. When markets fall, your SIP buys more units. When markets rise, those units grow in value. But when you stop your SIP during fear, you break the entire compounding chain. Every SIP you skip is money that never gets a chance to grow. That loss is permanent. it does not recover, it does not come back later. This is why consistency matters more than intelligence in investing. Now let's look at a small improvement that creates a massive difference. Instead of investing 10,000 rupees every month forever, imagine you increase your SIP by just 10% every year. Nothing dramatic, no sudden jumps, just a small annual increase. This usually happens naturally as salaries grow. With this simple step-up approach, your total investment over 10 years becomes around 19 lakh rupees. You invest more, but not unreasonably more, and the result is powerful. Instead of ending with 23 lakh rupees, your final portfolio value becomes roughly 35 to 40 lakh rupees. Same 10 years, same market returns, same discipline, a completely different outcome. This is the power of small improvements over time. Now ask yourself an honest question. Why don't most people do this? It's not because they don't earn enough. It's not because they don't understand math. It's not because they lack information. It's because lifestyle upgrades come first, and investments come last. As income increases, spending increases faster. Better phones, bigger houses, more subscriptions, more comforts. Investments are treated as leftovers, and leftovers rarely build wealth. Wealth is not built by earning more. It is built by controlling behavior, by staying consistent, by resisting the urge to stop when things feel uncomfortable. If you can invest consistently for 10 years, you are already ahead of 90% of people. Not because you are smarter, not because you are luckier, but because you stayed. You didn't quit, you didn't panic, you didn't constantly restart. This is how wealth is built in this real world, quietly, slowly, without noise, without predictions, without shortcuts. This is not exciting, but it works. And this is the wealth blueprint. Before we end, let's put all of this into perspective. 10 years may sound like a long time, but 10 years will pass anyway. The question is not whether time will move forward. The question is whether your money will grow while it does. Most people reach the end of 10 years and wonder where their money went. Not because they didn't earn, but because they never gave their money a system. They saved inconsistently, they invested emotionally, they stopped when things felt uncertain, and they restarted only after markets recovered. By then, the biggest opportunity was already gone. This is why wealth looks mysterious from the outside, but predictable from the inside. If you zoom out far enough, the pattern is always the same. People who build wealth do not make perfect decisions. They simply make fewer emotional ones. They automate discipline. They remove themselves from daily noise. They don't constantly ask, "Is this the best time?" They ask, "Can I stay invested longer?" And that single question changes everything. 10,000 rupees a month is not powerful by itself. What gives it power is time, and consistency, and the ability to ignore short-term fear. This is also why comparing yourself to others is dangerous. Someone will always invest more. Someone will always earn more. Someone will always start earlier. But none of that matters if you stay consistent, because compounding rewards duration, not comparison. If you begin today and stay invested for 10 years, your future self will be grateful. Not because you made a brilliant move, but because you made a boring one and stuck to it. Most people don't fail financially because of bad plans. They fail because they abandon good ones too early. If there is one takeaway from this video, let it be this. Wealth is not built in moments of excitement. It is built in long periods of calm repetition. Month after month, year after year, quietly. And when you finally look back, the growth feels sudden. But it wasn't sudden. It was slow work, compounded. This is the part no one celebrates. But it is the part that works. And this is why 10,000 rupees a month invested consistently for 10 years can change your financial trajectory. Not overnight, not magically, but permanently. This is the Wealth Blueprint, and if you stay with it long enough, it works. In the next video, I'll show you why most SIP investors never reach these numbers even after investing for many years. Subscribe if you want clarity, not hype.